Happy Friday! Hey, it's good to see everyone. This is Craig Modelmog for another episode of Wall Street X's and O's. Today is Friday, January 21st. It's hard to believe. You know, every time I get on here, I'm shocked at how fast time flies. It just cranks, but it's all good. It's all good. Welcome. I have a fabulous show today. I got some good stuff. There's all sorts of stuff flying around. It's like a stinking blizzard right now in the stock market and in the economy and on the political front. And there's just lots of good, juicy information. For those of you joining me the first time, this show is uncut and unedited. I grip it and rip it like John Daly, but I really try to focus on getting into the weeds, focusing on the things that aren't being discussed or that aren't being given the attention that I feel is necessary. With a really underlying emphasis on really educating you to help us all become better investors. At the end of the day, that's really what we're trying to do here, is do a better job of stewarding our hard-earned assets and taking care of them during times like this and growing them when the markets give us those opportunities. So before I get going here, we got to throw out the infamous disclaimer, because that's what the SEC and the state of Colorado require of me. So I will get on that here. We aim to please on that front, trust me. As I was audited last year, actually 2 years ago now, it was in 2020, and great people. We obviously did very well, but there's a lot of stuff that's out there you got to do. You got to do it right. Dotting the I's, crossing the T's, towing the line to shoot the free throw. Anyway, the content presented on this show is for informational purposes only. None of the information contained here constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute an investment recommendation, legal advice, tax advice, accounting, or investment advice by Cornerstone Wealth Management. The information is presented without regard for individual investment preferences and risk parameters and is not generally tailored non-specific information. And I just kind of messed that up there. But anyway, you can see my disclosures getting better. I've got to make sure that I'm hitting everything, because we do want to do it right. And lastly, investments are not FDI shorted. They can and will lose money, just like they are right now. So anyway, without further ado, and I probably already said that one time, we're going to do it again. Top three things. Volatility paradigm is shifting. And I said a couple weeks ago that I was very anxious to see, as we entered the new year, if the paradigm shift was going to reverse from being trending downward and decreasing volatility, or begin to reverse trend and upward in an increase in volatility regime. Right now, the things are shifting. It's happening. I'm going to talk about the newest unemployment numbers, which I haven't hit on those for a while, but we're going to really talk about the economic impact and where we've seen in most recent history when employment, what is driven it, how that impacts the economy, which obviously is the underlying focal point here, trying to get a better feel for what's happening, which then dictates positioning on what is to come. Okay, and then last things, I've got another great things that make you go, and no, I will not sing to you and embarrass myself any more than I already am. Volatility paradigm. VIX closed today at 28.85. For those of you that don't know what the VIX is, the VIX measures the inherent volatility in the options market, which is a direct reflection of the stock market and what's going on there. When the VIX is rising or high, usually the markets are down. When the VIX is declining and low, usually stock markets are up. Here's the challenge. There are three buckets that I outline when I look at the VIX. Okay, in each bucket, you can anticipate what is going on in the markets, and this is money. I'm telling you, if you want to write something down that I'm telling you, you need to write this down and track this, because the volatility paradigm is what really dictates what's going on in the marketplace. Okay, if we are in a low volatility environment, meaning the VIX is under 20, so from 0, which has ever been at 0, we've seen it in the low teens, to 20, less than 20, so 19.99, that is a very low volatility environment, which means that is healthy for stocks. Stocks go up in that environment regardless of what anybody is saying, and I mean that, okay? You have the middle bucket. which I call the chop bucket because it's a very, very challenging place to be an investor. The chop bucket goes from 20, a VIX of 20, up to 29.99. So between 20 and 30 is the chop bucket. Why is that hard? Look what's been happening this week. VIX closed today, what did I say, 28.85. It's been really cranking here the last week to 10 days and really starting to gain some momentum on the upside. If we break out above 30 and actually get to about 32 or 33, I will say that we do have a paradigm shift and we are now in an upward trending VIX environment, which is going to be bad for the market. It's going to be terrible. I actually think that's going to happen. Would not shock me if that happened come Monday or Tuesday with how the markets were today. We saw them open up down, then they briefly reversed, and then they just tanked by the year end, by the end of the day. It's pretty ugly, but so from 20 to 30 is the chop, meaning you have moments where volatility spikes, people get scared, they run for the doors. They're selling stuff, making emotional bad decisions. And then all of a sudden you see it start to come back down. You have a green day, markets are up, we jump back in and we're making another one, and it goes up and down and it just chops you up, okay? Then we have the last bucket was anything above 30. I call that the chuck bucket, and it actually rhymes with another word that I refuse to say on this, or my wife and my mom would probably ban me from doing my Wall Street X's and O's videos, so I will not call it that. So I have renamed it the chuck bucket, okay? And for those of you that have very good imaginations, you know what? You probably know what I'm thinking about. Here's what that means. Anytime the VIX is north of 30, it means that the stock market is uninvestable. You need to do nothing. If you haven't made your changes by the time the VIX gets to 30, it is too late. Just sit and shut everything off. Don't look at the markets. Don't do anything. Okay? The chuck bucket will just blow you up. That is vomiting on the streets. That is blood in the streets. You have all these Wall Street acronyms that are really gory, and I think it's kind of funny, but it's actually derived from people jumping out of buildings and doing bad things when volatility has really done amazing things in the past historically. So 3 different volatility paradigms. Remember those. Watch them. Look at them. Challenges ahead for the markets. We have decelerating growth and inflation that's taking place right now. That started at the end of December and has continued on. I'm anxious to see how that continues. Does the velocity of the deceleration pick up? That's the key. Not so much on inflation. Inflation, I think, remains elevated, although it is starting to subside. I'm more focused on the deceleration velocity in the economy, okay? Because right now, the data is saying we're going to have 2 quarters back to back, Q1 and Q2, where both growth and inflation are going down. That normally, especially if it gets to pick up the speed of that descent, usually means it's bad for the market. We do have elevated inflation, as I said. It's going to remain elevated. I do think that it is going to slowly subside. It's going to take time. Okay, supply chain is still not fixed. It's slowly unwinding. We've got a labor market that still kind of stinks, and it's just not good. The last one is the Federal Reserve. That's the wild card, I think. The Fed came out recently. At the end of last year, they said they were predicting 3 rate hikes for 2022. Now they're predicting 4. The other night, President Biden, I listened to his speech a little bit, and he said that, you know what, it's the Fed's job to maintain and to control inflation. I find it funny how the verbiage they use during times like this, which before they would never say control because that means manipulate. But anyway, I digress. So anyway, the Fed Chairman Powell's got his hands full here. And what I'm really looking at is a policy mistake. What does a policy mistake look like? It's going to be them raising rates more than once. I don't think they get into 2 or 3, and God, no way it happens on 4. That's not happening. Not happening. I think March is baked in because I think he has to. He said so much about hiking rates, and there's so much emphasis on it. All the big firms were clapping and applauding, which I don't understand that. They're idiots. But anyway, I don't see how they get more than 1 in 2 at the most. And then I see the economy starting to turn and go down, because that's like going 80 miles an hour and you pull the parking brake on your car. That's going to jar you. That's what 2 rate hikes would be, in my opinion. If that happens, I think the Fed cuts right back to zero and we're right back where we started from, which then that'll be a great, fantastic buying opportunity. So I actually hope it happens. I hope the poop hits the fan and it's going to be fantastic. Year to date with this volatility increase, here's some interesting numbers for you. If you look at the Bloomberg Barclays Ag, so this is broad investment grade bond index, it is down 2.07 year to date. Long-term U.S. Treasuries are down 4.57% year to date. The S&P is down 5.89, doesn't include today. NASDAQ is down 9.52, doesn't include today. Russell 2000, which is small caps, is down 9.83, does not include today. Correction land is 20% down from its high. We will be there. I would not be shocked to see that next week. And I'm not trying to scare anybody because I'm prepared for this. I was smiling all day today because I'm already set. I've been preparing this since literally December, actually since November. But so we're in fantastic shape. But it's going to be interesting to watch. But there is some challenges that are still out there, and it's going to be interesting to see. Moving on to unemployment here. It's been a while since I've touched on it because it's been boring. It's been continuing to go down. Pandemic is starting to go away up until Omicron. But here's what's interesting. Last week we saw a jump of 55,000 up to 286,000 unemployed individuals. Okay, those were new unemployed individuals. Now you say, well, Craig, why is that important? Well, if you look back, obviously Omicron is a big deal. Now you say, oh, well, yeah, but it's less potent. It's doing less hospitalizations and less death, which is true, but you understand my point here. Here's what's going on. The numbers of people testing positive is through the stinking roof. It's triple of what it was at the worst time of the pandemic when it was really bad, okay? Here's what is interesting. New poll or new source of, this is from the Census Bureau of Household Pulse, their Household Pulse Survey, which I was unaware of until right now. And they talked about those individuals that are out of work because they are caring for someone with COVID, ages 18 plus in millions, in millions. So these are by the graph goes in 1, 2, 3, 4, but that's millions of people. The graph peaked. Okay, let me create some context here. Back in January of 2021, it peaked at about, call it 6.5, right in that ballpark. Okay, we saw it decline. We saw it pick back up mid-year last year. Actually, August and whatnot rolled over, went back down. Now, Omicron, whatever you want to call it, explodes onto the scene, right? As of last week. Almost 8 million people not working because they are caring for someone that has COVID. Now, here's the impact of that. There's an economic impact, okay, that we have to think about and be cognizant of because that's how you get prepared for what's coming. You got to create your similar sets to where you start looking, okay, if this happens and this happens, okay, these are similar sets, and all of a sudden you have multiples of those, which is what fractal math is about. It's about a repetitive, what would I call it? I can't even think of the word right now. See, this is when it's proven that this is uncut and unedited. Pattern. God bless it. I'm glad I remember that. A repetitive pattern. I mean, you lump enough of those together, all of a sudden you got something, right? Well, here's what we've seen. Whenever we've seen big increases in COVID, consumer confidence falls. Service activity, what is service activity? Travel, hospitality, food, stuff like that, goes down. The service sector employment goes down. So you wonder why we had an uptick in unemployment? That's why. Is that good? No, it's crappy. It's not good. It's going to slow things down because we've seen it happen time after time. So be looking for another challenge to the markets ahead. It's going to add to this deceleration in growth, I'm telling you, okay? And if the Fed is going to raise rates into an economy that's decelerating, holy crap, cinch your seatbelt. It's coming, I'm telling you. It is just not going to be very pretty. So we got to keep our eyes peeled on that, and that's what I'm watching and I'm measuring and mapping on a daily basis, okay? Last things that make you go, this is a good one. New study here. This is by the Washington Post. I know nothing about the Washington Post. If you think that the Washington Post is full of BS, then you can not listen to this. I think this is a legit survey because it makes sense. It says 64% of Americans say that the government should do more to regulate tech companies, because it says most internet users do not trust how social media companies handle their personal information, with Facebook being numero uno, or now Meta. Isn't it funny how Facebook's up in deep doo-doo and they change their freaking name, think that it's going to make people not realize what's going on? It's garbage. It's just stupidity is what it is. Absolute stupidity. Here's what's interesting, and I'm going to go down and list all the social media companies and the percent of people that don't trust it. Number one, Facebook, 72% don't trust Facebook and the information they get off of it and how they use the information. Number two, TikTok, 63%. Number three, Instagram, 60. Number four, WhatsApp, 53%. YouTube tied at 53%. Google, 47. Microsoft, 42. Apple, 40. Amazon, 40. Here's the deal. If you get your news from any of those, particularly if you go to Facebook, if you go to TikTok, God forbid, although I know my son gets stuff off TikTok, and I'm like, CJ, seriously. Makes me laugh though. Instagram, they don't trust how they're using your data. So if you're going to these sites, they are soaking up more data. They know you better than you know yourself, and that is a scary thing in this world. So here's my challenge. Put down the phone, get off the computers, try to limit your use, okay? Because it is poison into our brains. It's just bad stuff because the algorithms out there frame up everything. And like I said, they show us stuff before we even know we want it. And it's a really sad and really pathetic thing. So I'm really trying to control that myself. But anyway, things that make you go, So I tell you what, it's always great to see everyone. Thank you for joining me on this cold Friday afternoon here in Fort Collins, wherever you're at. I hope that the weather is beautiful. I actually do love the cold and the snow here. I'm a ski guy, although I haven't been able to go skiing yet. Probably not going to happen, but that's okay. But I tell you what, I love it. Everyone take care, be safe, and until next time, I am out.